Good afternoon. It's my pleasure to moderate this panel, which is called the Changing Face of Banking, Rules, Risk and Resolution. And just to also put pressure on my distinguished panelists here, we got the main room because this panel and the topic got the highest registrations, and the topic is very attractive. But don't stress yourself. Of course, we have 4 panelists with one of them online. Okay, he's already on the screen, and I will introduce them in a second. So I would start with a few opening remarks, and then we also will have polls, so you can have your mobiles ready for that. We will be very happy to engage with you and be part of this panel. So let me start with connecting this session with this morning. We could hear in the high-level panel very nice hints about what we are going to talk about today, and also some ideas. And we would like to go a step further and bring you more practical view on how to connect the developments for the future of the SRB and SRM system, and how to best take these ideas forward in the next 10 years or even longer than that. So I would start with saying briefly that as we all understand, the financial sector is ongoing through significant changes, while on one side it's still completing the post-crisis reform in banks, and it's not yet fully completed. There are already a lot of new challenges which the banking sector is facing, and those are stemming from many things, but of course including the fast evolving technologies which are reshaping how the financial services are delivered, and also with new market entrants coming into the space of banking services, payment services, but also in a completely new area such as crypto assets. So these changes come with both opportunities and risks. And while the fundamental financial risks remain the same, there are also completely new risks, such as cybersecurity related, operational resilience, or data privacy related. And also with fast payments and 24/7 access, the traditional risks such as liquidity are now having different dimensions. So liquidity can evaporate now rather in minutes or hours, not in days or months. So services are also more interdependent and increasingly outsourced to critical third-party providers which operate worldwide and many times outside of the jurisdictions where the European banks operate. And also policymakers are paying attention to these new challenges and new risks. Just quoting 2 from last week. For example, the G7 Cyber Expert Group issued a statement on AI in cybersecurity, highlighting key issues and cybersecurity vulnerabilities addressed to central banks and supervisors, just from last week. And the second one is also the Eurogroup discussed the topic of stablecoins, and quoting the president of the Eurogroup who said that it's likely that stablecoins will start playing an increasing role in financial markets. So you can see that every week we have some news and some recommendations and identifications, so it's moving really fast. In addition, of course, we have this push, which you could hear about this morning, about regulatory either recalibration, simplification, or modernization. There are different words being used for very similar things, while we are also still implementing some new frameworks such as DORA or AI Act. So how to know what to do with all of this when it comes to resolution, and that's what this panel will be about. What are the implications from all of this development, and how to translate it into the activities of resolution authorities going forward. So in this panel we will first look on this evolution of the banking business, considering all these trends mentioned, and then in the second half we would like to get ideas from our speakers on how to explore regulation and also practices on the resolution side to adapt to these new challenges, and also if resolution authorities are equipped enough to deal and face these challenges. So let me start now with the introduction to our panelists. So I will start with those in the room. So we have in the middle Géraldine Thierry, representing one of the national resolution authorities in this panel, Director of Resolution of Credit Institutions at the National Bank of Belgium. So welcome, Géraldine. Then we have two representatives from the industry who also, it's very nice to have you here. So on my left side, Eric Pulling, CEO of Bank of New York Europe, and Jeremy Rosselli, General Manager of N26, one of the, let's say, neo or new type of banks. And last but not least, of course, we have online Executive Director of European Banking Authority, François-Louis Michaud. So very nice having you all here. But before I turn to with questions to you, we will start with a Slido. And we will turn to our audience here and online. And if you can scan the code, the same system as you know from this morning, we would like to get your view, and there is a question for you. So what do you see as the main emerging and growing risks, which is the most relevant from your perspective? You can choose only one to show us a little bit the view from the audience. So we have only 13 people, so it's going to be out there for some minutes, so you don't have to worry. I understand the Wi-Fi is not always very fast in the room. So it seems that so far we have cybersecurity and geopolitical risk as the two main ones to be seen. And yeah, we have around 66 people now there, 60, 70, okay. It seems that the trend is going with around half of the people highlighting the cybersecurity as the main growing risk. And yes, so now we have around 70, 80 answers. And the geopolitical around 30%, with technology risks going around 13 at this stage. And other as climate and ESG is at the lower end seen by our participants. Okay, so it seems that based on the views from the audience, the cyber security is seen as one of the main ones. So I will now turn with questions, and I will start, François-Louis, with you coming from the European Regulatory Agency. It's a very good starting point to give the first question to you. So in the context of the EBA role, which is monitoring innovations and also monitoring risk in the financial system, what are the main findings which you have on these new risks and vulnerabilities in the banking sector, and how is the landscape changing over time?
Thanks a lot, Slavka, and good afternoon all. I hope you hear me well. I have an echo, but I think it's okay. I'm very glad to participate in this panel to celebrate the 10 years of the SRB, which is a key pillar of the banking union. SRB is also a key partner for the EBA. And I'm very glad that we can celebrate all your achievements today. We work together a lot in the context of the EBA's resolution committee, and I really want to praise the excellent relationship we have with your colleagues. And I would also like to apologize for not being with you today. That's because we have an EBA board meeting in person today. So that's why I was stuck here in Paris. When we look at risks currently, we always tend to distinguish between two types: the risks coming from the broader environment in which the bank operates, and the risks, so geopolitical developments, for instance, and the risks arising from the financial sphere itself, including their own operating models. Now, you specifically asked about risks stemming from innovation, and as you said, we indeed are very active in that space. We monitor innovations through different formats, surveys, but also platforms, bringing industry participants, etc. Let me first maybe take a very quick step back. First and foremost, innovation is at the core of banking. So we should not think of innovation as a source of risk, but it's really core to what they do. And all pieces of legislation recently, starting with PSD, but most recently with the Digital Finance Act, with everything that's related to AI, etc., that tries to support innovation in the financial sector. Financial intermediaries, they have a key role to reduce asymmetries of information and to provide liquidity, as we know. They also compete against each other. And if they want to succeed, not even survive, but succeed, they need innovation and economies of scale. So we should support innovation. And what we see is that the one driving force behind innovation at the moment is technological innovation. And there's a special mention here for digital and ICT, of course. What we see is a massive transformation of the banking industry. And that's as a result of ICT and technological innovation that's happening both within banks for their front offices as well as for their back offices, but also in the environment in which they operate. And that brings both considerable opportunities and considerable risks for banks. I would not like to only focus on the risks of innovation, if you allow me, but also to say that this brings multiple opportunities for them. And it's just the way they embed or embrace innovation, basically, that's a source of opportunities or a source of risks for them. If we, cyber risk was mentioned, but first I'd like to focus a little bit on innovation and what banks offer. This started mostly with PSD in the past decade. PSD 1 and 2, they have unlocked innovation and security to the large benefit of clients. Banks were concerned in the first place. They struggled, they screamed, but they've managed to adjust. And this change brought a lot of mutual benefits for them and for the overall economy. We have now PSD 3 and PSR. This is also a source of innovation that will bring new risks and opportunities for banks, potentially open finance. But that's also something that can be very positive or very risky, depending on how banks react to that. Secondly, we've seen that banks have embraced, crypto-related products and services. So that's also an area which they are looking into, and they try most and foremost now to focus on offering crypto-related services for their clients. They are still a little bit, monitoring what's going on, but we have MiCA, and basically that's a big change in the types of products that banks will be offering. That may bring a lot of changes to their business models in the way they can really be or stay profitable. But that's a big change that they are also trying to take part in. Stablecoins is a key aspect, of course. We are closely monitoring that. There is a big push from across the Atlantic in this area. That means that banks cannot stay on the margins. They really need to take sides and be able to compete in that space. The digital euro is also a new component in the framework, because that will be part of the sort of range and menu of options for customers. So banks will also have to adjust to that, distribute it most likely, but also see how that could affect the way they collect deposits and the type of other services they could provide to clients. Importantly, we have fintechs and big techs, which are both competitors for banks, but which can also become partners to banks. And we see that there is a lot of white labeling, which is when a financial institution works with another company, a partner, which may not be necessarily a financial firm, and they offer products and services together under the partner's brand. Yesterday, we published a report exactly on that. It shows that over a third of banks surveyed in 25 use this model and have identified a need for more convergence in that space. So when traditionally taking the form of agreements between institutions in both the role of provider and partner, we found that non-financial entities are emerging increasingly as partners for banks. But that means also that there are multiple entities being involved. There is a fragmentation of the value chain that may create complex business models, and in turn, it can increase challenges and risks for consumers, providers, partners, and supervisors. So that's the offer. And now there is the way banks operate more fundamentally. And again, this is very related to IT, ICT in general. The digital brings more speed, more availability of services, 24 hours, 7 days. This is great, but at the same time, we have the risk of IT outages, cyber attacks, or even panics. And we've seen that, in the context of the Spring 23 developments in the US. So the banking sector stands out in terms of cybersecurity compared to other sectors in the economy. There is a lot of maturity, but still, it's an important vulnerability, and the poll just showed that this is well understood and well accepted. We've seen electricity outages. That might be seen as a sort of peripheral topic, but in fact, we see now that it's totally, linked to the way banks operate. That should be also taken into account when we do business continuity and resilience assessments. We also have artificial intelligence. I put that under the label how banks operate, because I am first and foremost interested in the way banks leverage that to develop their offers to customers, etc. There's a lot of opportunities that can mean more and better services for clients, but also a lot of efficiency for the banks. But if the models fail, if the systems do not work as expected, if the governance is not right, damages could be huge. And it's not only about reputation, but that's also about the way the economy and citizens could be funded. So all that brings a number of risks. I'd like to just stop for now, saying that we have also very positive features that we should keep in mind when it comes to banks. Banks are very strong franchises. They are seen as a trusted partner for economic agents. Citizens expect them to be on their side in the medium to long term. That's a plus compared to other types of financial intermediaries or non-financial intermediaries. They also have a very good track record. We've done 3 stress tests in a row, and banks, ended up with very high levels of capital. So that's a strength that should also be taken into account. And finally, they are embracing innovation at high speed, which is also a positive. Yeah. So I'll stop at that.
Thank you very much, François-Louis. That was a very nice overview of all the trends you see and then monitor and that very nice link also now to turning to Eric with the next question. Of course, also your bank have done through digital transformation as many other banks. So could you tell us also from your perspective how you see the key risks and challenges you have identified as part of this journey, and how are you addressing them in the concrete case?
Yes, of course. Maybe I'll start by telling a good afternoon to everybody. Happy birthday to the Single Resolution Board. Not easy to pass just after the lunch. I hope you still have some energy. If not, we're going to try to put some energy in the place. Thanks for the people who came here. I see some of my colleagues, so thanks for being here. I will have to be prudent because I see my general counsel is here, but I have my cheat sheet here, so that should be all okay. So to your question on data and digital transformation at BNY, I would say that it entails different aspects. I can mention two categories. I'll start with big data, cloud computing, cybersecurity. That's one dimension. Then the second dimension being AI, tokenization, and blockchain. And maybe I go a bit into the details about AI. We have created at the bank a BNY platform that we call ELISA, and we have enhanced that platform through a partnership with Sam Altman and his team of OpenAI. And what do we do with that platform? We do different things, but again, maybe two categories. I would say the first one is data sourcing, automation, data analytics, predictive analytics, those kind of aspects. And then a second thing would be in terms of generative AI, agentic AI, and then virtual employee. When I say that, agentic AI, we are having thousands of agents that we are using at the banks. Each and every employee out of the 55,000 employees of BNY is doing himself agents and using them. And then when I mention virtual employee, I really mean virtual employee. So those guys, they are having a Teams, you video call them and someone is appearing on the screen. It's a virtual person, but who is helping us in repairing codes, in processing payment, in repairing payment, and we have hundreds of those. So that's a big transformation. And on AI, I would say more importantly, we have a central team called the AI Hub, What do? They help us driving the innovation, but also building up a framework of risk and governance where, luckily, the human touch is present at all steps of the chain. So maybe now if I talk a bit about the risk, because that was your question, the risk that it generates, maybe I'll mention cybersecurity, I'll mention implementation risk, regulatory and compliance, and then I will say something on talent. So cybersecurity, when you see that we have all start using digital platform and AI, everybody is using that, the cybersecurity is significantly increased in terms of the number of attacks, but also in terms of the sophistication of the attack. So what we have done at the bank, we've invested a fortune in terms of data encryption, fraud capture, and then fraud mitigation. And I would say that the danger is in what I call the weakest link. So not everybody is able to invest massively in cybersecurity, but everybody is able to go into AI pretty quickly. So that weakest link, is those entities will implement it without the appropriate framework, and which created a risk on the entire financial system. On maybe the second one, the implementation risk, I'll mention the risks that derive from AI, which are a bit new. And I would mention their lack of explainability, logarithm bias, for example, lack of or loss of human control. Those kind of risks we try to mitigate as best we can through a dedicated AI project management. So for each and every project, we do it iteratively, and we are implementing a step-by-step approach where we always implement a little something, reassess, redesign, review with risk and compliance before going further and implementing further. Maybe I'll say something then on talents. Clearly being able to use the digital infrastructure is not something that we are all native with, so we spent also a lot of time and energy in our recruitment process, also in the training process. And I would say we work a lot with universities, tech company, and fintech to make sure that we are, let's say, cumulating the global intelligence. I'll say maybe just to conclude that I've used AI to prepare my text. And so for those of you who are gonna make a little note on today's conference, you'll probably send that then to your colleagues at the office. Before doing that, you will pass it into AI. Your colleagues are going to receive it. They're going to do a summary using AI and Copilot. So it's AI talking to AI. So we need to be prudent in the value chain.
Yeah. No, thank you very much. Just on the lighter note, I was when you said these virtual employees, I was for a second thinking that let's hope that you will not put them on the other side of the table when we will want to discuss resolvability, because that might be quite challenging for us. But of course,
I'm a true employee. I'm a true employee.
Yeah, not at this point. So now turning to Jeremy, to you. So also looking on this, let's say, new entrance banks more as opportunities due to also technological innovation. And I will also ask you later about some difficulties, but if you could also tell us how do you see the main opportunities which are arising from this new landscape we are talking about from business perspective? How do you see that future will evolve there?
First, I think I represent like the opportunities, right? I think thanks to regulation, thanks to technology, there is like a new wave of like newcomers, like in 26, but like in general, like it enabled the opportunity for newcomers just to enter any area of finance. When you look at like obviously like 10 years ago, nobody would have expected like a digital bank to have a banking license and actually to attract millions of customers. And when you look at like the finance industry in general, like you see that every single brick, and even more into the banking industry, every single brick can be, I don't like the term disrupted, but you can have newcomers coming, taking off-the-shelf new technology and offer to the customer something that is cheaper. So that is something that is like the opportunity here is massive, obviously for the end customers, but together with that, the risk is also super massive for the incumbents, especially the banks. I think there's a study from Bain explaining that 25% of the revenues from banks are at risk. Why? Because the newcomers can actually disrupt some part of the business, attract the existing customers, and this is a massive risk for incumbents, not only in terms of business, but even in terms of business model, because especially when you look at like how fragmented is the banking industry in the world. I mean, compared to any other industry, you cannot see like any industry that is that fragmented at this level. So there's a business risk. There's also a technological risk, because at some point, if you're a smaller player in some of the country, you might not have like the right skill set, or the right technological skill set, and so on to handle the skill set that is needed to compete with the newcomers.
Yeah, no, thank you very much. And Geraldine, of course, I'm coming to you at the end, because you will give us the perspective there, but I would like to use the opportunity still to ask two small additional questions to other panelists on what's happening in the sector. So because it's not only opportunities, but there are also some risk and some issues. You mentioned some of them already. So Eric, coming back to you, also considering that your bank, of course, it's American bank, and we had some indications here also what's this morning. So as a large US bank, what do you see also as key risk stemming from this current trends on the lighter touch regulation, simplification, or deregulation, whatever you want to call it, and also some possible changes in international tables due to the current setup? What are the implications from perspective of banks like yours?
Thank you. So I would say it's true, starting, it's true that we have witnessed a shift in the approach in the US, especially towards regulation and supervision. At the same time, it's also fair to say that the US banking financial system has generally promote a sound and robust banking system, especially post-crisis, and especially for GSIB. So it's also expected from the regulator, and I would say not only in the US, but also in Europe, to rationalize a bit wholesale regulation. I think that what we are expecting from the White House is that they're going to put a premium on innovation, on growth, and on streamlining the rules and regulation. What we are not expecting from the US administration is that they will walk away, to mention it like that, to walk away from international agreed standards. I had the pleasure of meeting Mr. Atkins, the SEC chairman, 2-3 weeks ago, and clearly his agenda was full on innovation. He was mentioning two main aspects. One, trying to be less restrictive for financial markets. And secondly, trying to, let's say, upgrade, improve, modernize its framework at the level of the SEC for cryptocurrency, for blockchain and digital assets. So you were wondering about the risk that we see. Maybe I'll start first by telling that in general, US banks are welcoming the approach of the US administration to look at regulatory burden, to look at capital reduction where we need to, look at the transparency of the stress testing. Also, we are very welcoming the look to innovation and digital assets. I mean, if you look, for example, at the Genius Act relating to the stable coins, we think that it's really a good step towards the right direction and propagating blockchain towards the financial industry. But maybe to go to the, let's say, negative points or the risks, I would say the first one is when you have dispersed regulation, but clearly that's not something that we like. What we want as global companies is to be able to apply a consistent compliance and resolution, and here it is limiting that opportunity. And maybe I'll say something quickly on the tariffs. Well, the tariff was massive. We see a lot of impact on volatility and uncertainty in the markets, and you know that financial markets, we don't like uncertainty. It's creating a lot of credit risk valuation issue. It is reducing also or slowing down the investment, so clearly not something we like. So, I mean, if you sum that up, there are positive and negative aspects, and I think we need to be agile and adaptable in our approach.
Thank you very much. And now let's move, Jeremy, back to you. We also touched the topic of liquidity. So, in this context, of course, the digitalization and fast-moving payments and can also expose banks to rapid liquidity shifts. So, in your view, are these neobanks more exposed to this risk compared to the traditional banks? And how do you see the overall this risk of liquidity from?
As a French person, I would disagree. But like in general, the very first thing we do, even if we are new banks, we still invest in traditional experience. So the very first thing we do is actually hire experienced banker. The second thing, I think it's worth also mentioning, not just because there's lots of regulators, but there's really like a strong connection with the regulator across the board in all the different countries. They really embrace innovation. They want to bring the newcomers up to speed. They also try to understand how they need to tweak or adjust the regulation to meet obviously like the philosophy, but also to understand the new business model. So that being said, I cannot say that there's less risk, but I would say that the risk that you would see, for instance, for liquidity risk of a new player is no different from any other traditional player. Everyone here in the room, they can make any transfer from their bank, whether they are a customer from N26 or any traditional bank. So the risk is no difference anymore. But I would go even further. The truth is that when you look at like newcomers, we have our business model. There's still like simple. So we were born at an age where like the interest rates were negative. So our business model is not necessarily based on our balance sheet. So the complexity of a balance sheet of a newcomer is actually much more simple. The second thing I think is also worth mentioning, by design, we haven't started to do massively credit. So again, it goes with the balance sheet. We have less risk than that. And then on top of that, thanks again to the regulation, most of the players are active across Europe. So there's also an effect of diversification because like most of the players now are not just acting in one market, but thanks to passporting, we are now live in 24 markets, which also bring down the risk. I cannot say that we're less risky, but at least I can say that we shouldn't see any different of risk for new players than incumbent players.
No, thank you very much. So, Geraldine, now let's put this all together for the resolution authorities. So, how do you see the role of resolution authorities looking on all these new risks and the landscape and all the environment and issues described here? So, what do you think that we should take out of this?
Yeah, thank you, Safka. They are indeed new risks, and they are likely to trigger unexpected crisis. Yet, I think the question before us is not only how to react to crisis, but well, how to build a financial system which can stand them, can really absorb the shocks and emerge stronger. So, in other words, the question could be, how do we build a robust financial system? And here I refer to a very precise definition of robustness, drawing on the work of the biologist, a French biologist, Olivier Amand. Robustness is not about bouncing back after a shock. This is resilience. Robustness is about creating the diversity, the redundancy, and the tolerance for error that will allow a system to stay functional despite a shock. So this is different from resilience. So it's not about perfection, but it's about stability amid uncertainty. And I think, if your question is what is the role of resolution authorities, I really think that the role of resolution authorities is precisely to be key actors of robustness. Let me maybe illustrate with the three dimensions of robustness, so redundancy, diversity, and tolerance for error. And I will start with tolerance for error. The prudential framework accepts that some banks will fail, and that's not a flaw, actually. That's a feature of a healthy system. Our role as authorities is to ensure those failures are contained, are orderly, that they don't trigger contagion. And in biology, a single damaged cell, for instance, does not kill the organism because the body isolates it. And the same logic applies in resolution. We isolate the failing parts in order to protect the whole. The second dimension of robustness, on which I think resolution authorities should also play a role, is redundancy. Actually, biological systems are hyper-redundant. If you take the example of multicellular organism, in most multicellular organisms, chromosomes come in pairs. This means that if a gene is missing or not working on one chromosome, the other chromosome will still provide access to a complete set of genes. And actually in banking, redundancy takes the form of buffers, capital requirements, MREL, at individual level, but also the SRF at a mutualized level, collective level, at European level. And these resources may seem costly, and here I look at my neighbors. This may seem costly in good times, perfectly understand, but they are precisely what allow the system to survive in case of extreme shocks. And in that respect, as Claudia Book reminded us this morning, but also in Le Monde recently, rolling back regulation would probably be, would be a mistake. The third dimension of robustness, on which I think also resolution authorities must play a role and do play a role, is the diversity. A robust ecosystem relies on diverse solutions, not on one optimized model. In the same way, we must preserve flexibility in resolution planning. Different tools, presumptive paths from which we might have to deviate, as it was the case for Sberbank, for instance, tailored to each crisis. And that diversity is what allows adaptation when unexpected happens. So in a world of growing interdependency through digitalization, for instance, geopolitical fragmentation, we have covered this morning, cyber threats, which is becoming greater and greater. You spoke about the number, but also the sophistication of the potential attacks. Resolution authorities have an essential role to play. This is to anchor robustness within the financial systems. And in this sense, if I can go on with the biological analogy, we could consider that SRM, that we are celebrating today, is the immune system of the banking system, absorbing the shocks, localizing problems, and keeping the organism alive through safety margin and a diversity of powers and of tools. This is why deregulation, instead of strengthening the system, would actually risk to making it more fragile. True robustness comes not from removing safeguards, but from designing systems that can live with uncertainty. And this uncertainty today is super high. This said, I agree that there is some room for simplification, rationalization of our prudential and resolution requirements, for sure. And we have already mentioned some ways this morning. I think that there are, in several cases, actually robustness and simplification can go hand in hand. So let's take the case of data and reporting, for instance. When we talk about robustness, having an integrated reporting systems would definitely make a difference. Having a centralized reporting framework means that all the key data are accessible, available in real time. And this, in times of crisis, is crucial because it allows for faster and also better informed decisions. It also brings a much-needed simplification. And here again, I look at both of you, but instead of multiple overlapping reports, we get one consistent framework, clearer visibility, less duplication and effort. So in the end, both supervisor and the sector benefit with a better information, less noise, stronger decision-making. Maybe another way to increase robustness while implementing simplification is in reducing the inefficiencies that do not add to robustness. And I think we are already seeing some progress in the area at the SRB level. For example, the SRB's work on simplifying the resolution planning cycle. The idea is to ease the administrative burden where we can, now that we have reached a certain level of maturity in resolution planning. And so once certain deliverables, like playbooks, for instance, have reached a mature stage, their submission frequency can be reduced. And this is exactly the kind of pragmatic approach that helps us to stay both robust and efficient. So finally, and I will end there, we also have to test, and this is something very important, Slavka, to test whether our approach works. We have to make sure that even if we simplify, we can still deliver on our mandate. And fortunately, testing is at the core of our SRM 2028 strategy. So this is a good news, I think.
Thank you very much to all of you in this first round to share the views on risk, vulnerabilities, opportunities. And I have to say that there was a lot of similar words used by each speaker, which I would use too much time to try to summarize all of them, but I could start with François referring to innovation and competition, or increased competition due to the, of course, then moving to data digital transformation, all the way to use of AI assisting in many ways, but also bringing new risks and human factors still there, and also then going into cybersecurity. And then we entered the field of biology unexpectedly, and it's a very nice way of thinking about the role of resolution authorities to ensure robustness. And in a way, what I got out of it, that also in the nature, you know, some elements have to die for others to survive. So in a way, that was not your message, but in a way, that's how the nature works. If we make this, so it's normal then that, of course, that as part of this process, linking it with the role of resolution authorities, that we have a system where we can work with the situation where somebody is either resurrected or let die. And that's robustness and making the system immune. That was very nice, that in a way building robustness into the resolution framework is increasing immunity. So it's like immunization kind of a type of tools. So maybe we could change the terminology of what we do and start entering into the world of biology and be inspired by that terminology. So now let's move to the second part of our discussion, which is much more about, okay, so we know roughly where we are. We have some view on risk opportunities, and we have some worries about the main, let's say, main threats coming from all these developments. So what does this mean for resolution authorities? What does it mean for SRM and SRB? If we could get your help, where to focus our effort for the upcoming years. And again, we will start with audience. And we will start the second Slido, second question. So I hope that you got a lot of inspiration from the speakers about where we are with risk and opportunities. And based on this, and knowing the tools which resolution authorities have at their disposals and what we use, so what do you see? What should be the core area where we should, as resolution authorities, we should concentrate on most or more than other if you can choose only one. And then we only give you 4 options. There will be many more, but that would take a bit too much time. But this will okay. So now I see that with 40 people voting, it looks like testing as the tool is the one which our participants see as the most relevant. Now we are around 67 people. So liquidity and resolution, that was also mentioned by the high-level panel this morning. So that's also quite important topic to be looking at, and increasing optionality. So in a way, it's, let's say, there is 41% for the testing, but it's not like the over 50% majority view on one topic only, but looks like testing is seen by our audience as the main area where we should concentrate. And it's one of the, of course, important areas where SRB is looking. So I think I don't see the number going up, so probably people already replied. So it seems like the testing is seen as the main area. So with this, I will start the second round a bit the other direction. So I will first ask our private sector participants to give a little bit of context to us. And then I will go to the public sector participants in this panel to wrap it up and give their views on the direction for the SRB. So I will start, Eric, with you then. So based on what we discussed, so how do you see that, how must the resolution planning evolve to ensure continuity of operations in this new environment?
So it's always difficult to, when you're in the banker's seat, to give advice to the Single Resolution Board. I was chatting with Jeremy about that at the lunch, so it's an open opportunity. But because it's your 10th years anniversary, I'm going to start by mentioning that the Resolution Authority have built up a resolution framework that is very strong and robust, and that has really enabled us bankers and generally financial institutions to be much stronger and resistant to crisis and to issue in the market. I would also say, because it's your birthday, that the framework, the resolution framework, is adaptable, is agile, and is in a way able to evolve with the evolving banking sector. But I would say building on that framework would be nice that the, let's say, Single Resolution Board continues the reflection around the growing dependency on technological development, and especially, AI. And when I say AI, blockchain, tokenization, stable coins. And if you are thinking about that, I think that to make the link with continuity, you have to put into consideration strong fallback protocol. You have to consider audit trail for automated decision. You need to make sure that there are manual control override at each stage of the value chain. And in a way, you need to upgrade your framework, striking between, I would say, the need of innovation from one side and the need of resilience from the other side. So the Resolution Authority have helped us, in the past to face a lot of crises. And I think it would be nice that they continue to help us anticipating what can come next by integrating in the resolution framework those aspects like AI, but also in the testing, and I see testing is number one there, but clearly integrated in the testing, in our simulation, the impact of AI, loss of human control, inappropriate, let's say, automated decision, that's clearly something that is important.
Okay, no, thank you. Very, very interesting and something to think about. I see Dominic there, so we will take that home. So now coming to you, Jeremy. So we also touched briefly the topic of outsourcing and cloud-based core services. So how does this affect your own business continuity plans, and are resolution frameworks fit to address the risks related to the third-party providers?
Wide questions. So by design, obviously we're a bank, but we like also to define ourselves as a tech company. So I think all the part that is continuity in terms of tech, in terms of outsourcing, is something we've been embracing as part of our DNA. I think that's a big difference between incumbents that sees that as a cost center. For us, it's part of our DNA. Whenever we enter a partnership, like you talk about, like cloud, for instance, that's something where by design we will look into continuity, we will look into resilience. Actually, we had discussion with all the regulators on how actually some cloud can be more resilient than having like physical frameworks. So really, this we made some great progress there, and I think it's really part of the DNA. What I still see, at least in general, like yes, there is still a risk that unfortunately, like the resolution board cannot cover, because by design we are now relying more and more on third parties, not just us as digital players. I think everyone in the room, we all more and more rely on third parties at one point. So obviously we're doing all the due diligence that is possible. There is clearly some risk that unfortunately at some point, if there's some resolution, for instance, and there's tons of cases, and just talking about like cloud computing, for instance, if like the data provider doesn't want to give the data, if there is some sovereignty issue where they want to keep the data and block access, this is clearly like a risk from a resolution that creates like a huge resolution issue. I mean, you would agree with that. So that's one of the area that creates some problems. And I think that's an industry topic that at least we need to acknowledge. Second one that I also foresee, I will take a different industry example that also is probably not covered there. But for instance, you all heard about like CrowdStrike, right? Like just like one antivirus that is not covered by DORA, that is really like a third party, and nobody knew that like half of one industry were using the same supplier, and that this one supplier could ground literally half of the planet. So this is also something where when we're talking about risk, and some of them are well identified, some of them when we're talking about technology, when we're talking about suppliers and third parties, that's clearly one of the risks that I can foresee that unfortunately yet, I'm pretty sure you will find some solution how we can actually ensure the stability of the system and actually making sure we can cover this kind of risk.
Mm-hmm. No, thank you very much. Again, a lot of food for thought on those and how to take them forward. And in a way, also public authorities go to use the same cloud providers many times, and we are in a way all in the same situation when it comes to the dependencies. And yeah, so now turning to you, Geraldine, to give us perspective from, let's say, one resolution authorities, and then François-Louis to give us the EU-wide view on the future. So we heard specific areas where maybe we should reflect, but Geraldine, for you, if you could give us more broader view on how you think that the resolution authorities and framework should evolve to be ready for what should be also considering us, our audiences, that the tools which we have, which should be the main one to be used going forward, and how to best adapt in this situation for the practical application, let's say by SRM or in general by resolution authorities.
Yes, and indeed they should evolve. I think, and I think my intervention will definitely echo some of the risk that you pointed out, because the risk we face today go well beyond the traditional crisis that the framework was originally designed to address. You just mentioned, Jeremy, some of them, but the resolution framework was built primarily for classical financial shocks, solvency problems, systems, maybe liquidity crisis, certainly losses in confidence in the systems. And for those scenarios, let's say of classical crisis, it works. We have tools, we have requirements, we have procedures that are very clear and that are more and more operational. But the world has changed. And we now face systemic threats of a different nature. Cyber incidents, you've mentioned them. Operational disruption, I will come back on it because I think it's crucial. Geopolitical shocks, of course, climate-related risks that come maybe more and more in the future. Risks that, all these risks strike not only risk not only to balance to strike our balance sheets or the balance sheets of the bank, but the very infrastructure. And on this, I would like to come back, the very infrastructure on which financial stability relies. And they are not solvency crises, they are crises of continuity. And so I was very pleased to listen to you when you said in our DNA, the question of continuity is really by design in our concerns, in our way of work, and I would definitely be very happy to learn more about this after the panel. We probably, as Resolution Authority, have a lot to learn from this. So these crises are crises of continuity, and they require us to evolve because a bail-in will not solve a problem or an incident with subsea cables, for instance. So first here I see different way in order to make the resolution authorities evolve. So the evolution begins, I think, with our expectations for a bank. So you all know here this, the SRB's expectations for banks. You know that they were major steps in a major step forwards in defining and ensuring resolvability. But as risks evolve, so must our expectations. Until now, much of the emphasis has been on financial and structural preparedness, so MREL, separability, access to FMIs, governance, liquidity and funding, although it remains a very important problem to take into account, information systems, access to data, and communication. And part of these are actually related to operational continuity in resolution OCIR. And going forwards, we need to ask ourselves whether we should give a greater importance or prominence to operational continuity in resolution and possibly strengthen our expectation in this regard. Because if core systems fails or data are corrupted, this is precisely the example that you take, no bail-in, no bridge bank, no asset separation can function effectively. During the floods that struck Valencia in 2024, and Pedro is there, and you are the one who told me this, you've seen that some Spanish banks highlighted to the SRB how important it was and how happy, if I may say, they was to be prepared for operational continuity. So I think whatever the crisis that comes, if this is a crisis that touches the continuity, we should definitely put more prominence on this dimension. In short, our expectations should, I think, increasingly capture operational interdependency and not just financial interconnection. The second way I see a potential evolution is that evolving risk require us to reconsider our own risk appetite as resolution authorities, and the risks are shared between the public safety net and the private sector. Banks, of course, are natural risk takers. This is your business model. But some of today's risk, cyber, geopolitical again, environmental, are of a magnitude that no single institution can fully internalize alone. And so we need to ask ourselves, where does the responsibility of the private sector end, and when does the public safety net begin? This does not mean, of course, creating a blanket protection or public backstop for every type of risk, certainly not. On the contrary, I think it means being clear and transparent about what we can do, but also about what we cannot do. And we have to manage this within the resolution framework. If the systemic effect of a cyber event, for instance, or a climate disaster cannot be contained with the existing tools, then perhaps we need to expand our capabilities, maybe asking advice to the bank and tech enterprise. For instance, by developing specialized crisis mechanism, strengthening cooperation with cybersecurity authorities, or building targeted responses protocols, for instance. And as we do so, we must revisit, as I said, our risk appetite. What level of disruption do we tolerate before acting or before intervening? What part of the shock should be borne by the markets and what part should be borne by the safety net? And possibly, which part is not managed at all for the time being? So because at the end of the day, resolution authorities are not superheroes. Slavka, we are heroes, but you will agree with this, but maybe we are not superheroes. And so more seriously, they may not have the right tools in order to manage some of these new threats and new crises. So this calibration is essential to maintain both accountability and robustness. And finally, at your question of how should we evolve, a third way I see as a potential evolution is adapting the framework does not mean weakening it. And this is really an important point that I want to make it here. We must resist the narrative that equates deregulation with agility. Robustness, as in biology, comes not from removing safeguards, but from creating systems that can live with uncertainty. We are not in the same world anymore. So yes, the resolution framework must evolve by integrating new types of risks, by revising our expectations for banks, and by refining the balance of responsibilities between private actors and public authorities. And only then can we ensure that the resolution framework remains what it was always meant to be. Not a tool for reacting to crisis, but a mechanism for keeping the financial system robust in an age of uncertainty.
No, thank you very much. Really strong points to take forward. That's a very nice bridge also back, François-Louis, to you now, because in the context of also EBA work, EBA is setting priorities, main priorities for supervisors, but also main resolution priorities. And in this context, you are preparing what's called European Resolution Examination Program. At the same time, also, we talk about the risks, which part of them are supposed to be addressed or are addressed by DORA framework implementation. So how do you see all of this in setting these priorities in DORA implementation and implications for a single resolution mechanism going forward? How to take this forward in a way to be robust and to be better prepared for the new challenges.
Thank you, Slavka. I'll try to tackle both without being too long. I tend to see you as superheroes because you are tackling a big enemy, the too big to fail problem, and you have a big bazooka, the single resolution fund. So I want to think that you guys are superheroes. We've published a bunch of documents on the 1st of October, which I can only recommend to the audience. One is our work program for 26, and it includes the priorities you were referring to, Slavka, for prudential supervisors and for resolution authorities. But it's also published with a companion document, which is about simplicity and efficiency of the financial framework, and that echoes some of the previous comments. So I'll say a bit on both. On the priorities themselves, so we do that because we've been asked to foster convergence between supervisory and resolution authorities within the framework. So that's a key element. So to make sure that there are no blind spots in the way the key risks are being addressed. The priorities we've adopted for 26, they include, there are two of them, in fact. One is monitoring and addressing financial stability and sustainability in the context of evolving interest rates and geopolitical risks, so it's a lot. And secondly, it's about developing an oversight and supervisory capacity for DORA and for MiCA. First and foremost, behind that, we have the cybersecurity risks, because we know that they are front and center for the financial sector. All indicators we look at point to that. And that means we need to do something about that. So for prudential supervisors, we encourage them to consider the impact of all those developments on the banking sectors, on the firms they supervise, but with a special focus on dependencies coming from third countries, where an important number of key services might be coming from. So there's this notion of, the financial sector is also dependent on a number of services or relationships with partners who are also originating from outside the union, and that should be specifically looked into. So we encourage them to look into banks' governance and risk management, and to see whether those aspects are up to the task in an evolving environment. For resolution authority, we focus a lot on testing. We believe that, cyber, geopolitical, everything, natural disasters, everything that was mentioned before, that is likely to play a key role in resolution, situations going forward, and authorities need to be prepared for that. So we've seen that, especially in the case of SVB in the first quarter of 23. Transformation of the banking sector led by digitalization can massively affect resolution planning and resolution itself. Bank runs are much faster. It's not possible to wait for the resolution weekend anymore. So resolution authorities need to be ready to quickly and effectively act and implement their strategy. And for that, testing is of the essence. So all types of exercises about resolvability that can be performed will help. Now, on the simplicity and efficiency of the framework, and it's also something that we believe resolution authorities need to be really involved in, and we know that you've started working on that, but we've been building up this framework for the financial sector over the past decade or even 15 years for good reasons, and there is a lot of strength in the system, and we should certainly not lose that. But at the same time, it's become increasingly complex, very difficult for authorities themselves and for financial entities to understand and to operate. So we've put forward those 21 proposals for streamlining things, for improving the rule book, for creating platforms, for gathering information in a much better, more efficient manner, for having more coordination amongst authorities as well, and for simplifying the rules, taking a more holistic approach to macro resolution, and also AML aspects going forward. So we believe that this should be a key area also for attention. It's not exactly resolution, day-to-day resolution work, but it's really also how we can collectively improve the system together. Now, DORA is also a game changer. You mentioned that. Of course, this is a game changer. We believe this should help a lot financial firms to be more proactive dealing with those risks. Authorities also should be, should have a much more preventive mindset, better prepared, have a crisis preparedness approach. Why? Because DORA provides a lot of information and tools that will facilitate crisis management. And a key element to that is the cyber incident reporting that DORA allows, that we've started collecting those incidents. They are a very important source of information. We disseminate that across the supervisory community on a, real-life basis, and I think that will also facilitate adequate responses, adequate solutions to any issues we might be faced with in the future. So I'll stop at that for this round, but I could speak at length about DORA because it's a really important development. Usually we speak more about DORA as far as its oversight of CTPP's part is concerned. But there is also another element, which is this incident reporting and convergence of supervisory and resolution authorities work. That's also important, and that we should not lose sight of. Thanks.
Thank you very much. Before I conclude, I would like to also give an opportunity, maybe if you would like to add or react to remarks of our panelists in this second round. We heard a number of good ideas. Is there something else to add? We have still some time. Yeah.
Maybe I can start just because I saw testing was the #1. We didn't talk about testing in our intervention. So if you think about testing, the way we do it at the bank, so we are having as prime regulator the ECB, but as second regulator the Fed, but then the FDIC is also having an impact because we are considered as a material entity under Title I, and so we are submitted to a lot of testing. And the simulation testing we do, just to demystify it, that's probably one of the most funny exercise we are doing at the bank. When you do the simulation, you do it really like if it was kind of a gameplay. You invent a scenario doing reverse engineering so that you break your ratio, your regulatory ratio, your liquidity, your recovery indicators. So you need to think through. And then you start really playing the game. But if you think about the size of our, playbooks, the size of the recovery plan, the size of all the technical notes we have built up for resolution, that's thousands of pages. So it's difficult for the people to, when the problem really come to surface, to say, okay, what do I have to do? Oh, it's on page 972. It's complicated. So if you are not testing it, and that document is something that you put in a drawer, you're dead. And so just by playing the game with the teams, with the board members, with the INETs, having the regulator intervening in the discussion, so we have them observing, the ECB is observing, the resolution authority is observing. It's a lot of fun, and we learn a lot of stuff. I do it for the last 12 years that I joined the bank, and every year we are learning something.
That's very positive to hear from the perspective of resolution authorities, because of course we also understand that it's demanding on resources, some cost, and because we also believe strongly in testing on our side. So this is it's very nice to hear that practical experience. It's all good. Yeah.
We had this discussion just before entering on scene. So I think, yes, by design, and we see that really as an investment doing that. I think it's pretty key. And the more you see the world evolving, the more it's clear that like testing, having all those scenarios and understanding what can, I mean, we cannot predict everything, but at least like being more prepared and being more prepared to be ready, I think it's super key. One area that we are pushing is just simplification. So I think in general we are pro-European, and that's our position. And for sure, the more impact we can have is being more simplified, more having like the same approach across all the markets, all the bodies. I think for us as a player makes our investment. We can invest even more like in deeper if we by design like everything is more simplified, and we don't have to do redundant work. Because we work in different markets, we do work in different areas. At the end, it's still like the same work that needs to be done. So it's not an ask, but I think we all want to work to walk in that direction where simplification and unification across the board in Europe is key for all the players, both on the regulatory side, but also on the player side.
Okay. No, thank you very much. Geraldine, would you also like to add?
Just to echo what you said regarding the operational risk, I think we definitely have to focus on that. And I think that the operational and testing approach that the SRM is taking now in the Vision 2028 is really going in the right direction, because it echoes, I think, some of the concern that has been expressed here. I would also stress the fact of how much I understand that simplification is necessary, but I would like to remind, as many of us, that simplification does not mean deregulation, and then there, indeed, if we can simplify where indeed we do not hamper robustness, I think it's indeed the right way to go in order to increase the efficiency also of the measure that we take, because indeed, if they are considered as too burdensome and too heavy to put into practice, they will not be applied at all, which is not what we want either. So simplify in order to be there where we are. We expect more robustness.
Yeah. No, thank you very much. So to conclude on this second part, so what I hear from two representatives from the bank side, in a way, telling us that increased dependencies is something for resolution authorities to pay attention to, impact of AI on everything we do, cybersecurity-related threats, and also this technological companies and where they are placed and how third-party providers and related concentrations. So these are, let's say, the line of thinking given to us. Then from the public authorities, from Geraldine and from François-Louis, starting with saying that yes, we will continue having expectation and should continue having expectations on banks. We want to simplify, but the life is complex. The technologies and development is making our life complex. We are well equipped for individual financial crises from all sources the framework was designed for, as liquidity, solvency. For the other types of crises, we have to think how we are able to deal with it with the current tools. But it doesn't mean that we will not have expectations on back. So in a way, we are in this together. So when it comes to the broader resilience and robustness of the system is important. Very interesting point made by Geraldine about the risk appetite of resolution authorities. Should that be adjusted and how to reflect on this? And the tools to be used, and that's also already reflected in the priorities set by the EBA, with the work testing being set by everybody. So through testing, either on the side of banks and on the side of resolution authorities, work on different scenarios. Through these scenarios, learn how can we operate under some circumstances and how to adapt our toolkit to be able to react. So DORA should help us in practical terms to be better ready through also more data which are collected through that. And simplification, yes, we all agree it's a good idea, but the system is complex, so we have to be careful that it doesn't mean deregulation and doesn't make us weaker, because in a way, this robustness of the system, it's for the benefit of all of us. Then I think on a lighter side, it's very nice to know that resolution authorities are considered to be superheroes. So for my colleagues for SRB, don't forget that from this conference, that your work is so important that you are considered as a superhero. And yeah, it's a lot of responsibility and in a way being prepared for unexpected. So this uncertainty is in a way in our core mandate, how to live with uncertainty, and uncertainty is in a way increasing or coming from different sources. So with this, let me thank to four expert panelists from both private and public sector for coming and sharing your thoughts and giving good ideas to SRB and SRM system how to move forward. And we will also reflect on this, and let's just hope that also that all of these ideas will not have to be used too often, let's say, because we hope that the system will be robust enough to ensure immunity, and that when the action needs to be taken, then we are well equipped also for these new challenges. So thank you very much also to our audience for participating, and I hope that you found this discussion very engaging and inspiring. So thank you very much.
Thank you.